Good afternoon, and thank you for joining us today. Welcome to the Savings Bank live webinar on the 2021 Economic and Market Outlook. Our presenter today is Brendan Szocik, President and CEO of First Financial Trust, a subsidiary of the Savings Bank. Brendan has been with First Financial Trust since 2003 and previously held the position of Chief Investment Officer. He chairs the investment committee, oversees trading for the firm, and oversees research efforts. Brendan has experience both as a portfolio manager for individual, corporate, charitable, and trust accounts, and as a former trader and specialist assistant at the New York Stock Exchange. He earned his bachelor's degree from RPI and holds a Chartered Financial Analyst designation. He is a member of the CFA Institute and the Boston Security Analyst Society. My name is Karen Benedetti, Vice President of Marketing at the bank, and I will help facilitate the webinar today. All microphones are muted during this webinar. Please type any questions into the question and answer box at any time as we go through the webinar. Look for the icon with the question mark. Brendan will be answering questions submitted at the end of the presentation. For your privacy, no webinar participants will be seen or heard during this event, except the presenter. Questions will be read anonymously. We will also provide contact information at the end of the webinar for questions on today's topic. Now let's get started, Brendan.
Thank you, Karen. And thank you all for joining us this afternoon. Hopefully we've all become accustomed to doing things this way over the last 12 months. Video teleconferencing is certainly something that I wasn't familiar with prior to this, but is kind of, I think, something that'll be with us for a long time. So thank you, and hopefully you're all able to join and listen in. So I wanted to kind of get into it right away. We've got a little bit of limited time here, so just kind of want to talk about where the markets have been over the last 12 months. So before we can really kind of make any predictions or lay out any expectations of what you see going forward, it's important to know where you've been and how you got here. Last year was such a unique situation. It was such a dramatic entire shutoff of the economy. This wasn't something that was fundamentally driven. There weren't any, cracks in the system that led to the sell-off that we experienced. This was a real kind of a one-time outlier that took an economy that was actually really firing on all cylinders. Unemployment was at record lows, and things were going along quite nicely. And then, literally just fell off a cliff, and we flipped a switch. So we went from this robust economy to everything shut down, in the immediate term. And it actually led to the steepest decline in stocks on record. I know that might sound dramatic, but we've had other situations where the market has sold off more from an absolute standpoint, but not in the time frame that we experienced. The S&P 500 lost over a third of its value, roughly 34%, in just 5 weeks. So even 08, 09 and other sell-offs, it took months to really kind of find a bottom before we turned around. This was such a rapid and unique situation. But coming out of it, conversely, we had one of the biggest and quickest recoveries we've had on record. It was only the fifth time, I think, since World War II that stocks have appreciated 70% in less than a 12-month time frame. So a very, very deep but very fast correction in the markets and the economy. But the reality is, as you probably had noticed, it was really a tale of two markets coming out of those March lows. We had tremendous appreciation in the companies that benefited from the do everything at home. People were working from home, socializing from home, eating at home, learning from home, and all the companies that kind of supplied the necessary tools and technology to support that saw tremendous growth, not only in their businesses but in their stock prices. So we saw a really kind of a tale of two cities in terms of the types of stocks that did well coming out of the lows of March. And in fact, if you looked for all of 2020, while all stocks recovered and ended positive on the year. The Dow was up, I think, about 7%. The NASDAQ, which is very heavy in technology, was up 43%. So you kind of had a winners and losers feel to the stock market in 2020 based on that environment. We've seen that rotation start to happen, though, where now that we have kind of a light at the end of the tunnel, you're seeing money come back into some of the other economically sensitive names. But there's no question that there was a lot of kind of growth pulled forward in those names. We all know them, the Zooms, the Pelotons, the DocuSigns, the Teladocs, everything that benefited from that. So, I guess where I want to address the first question right up front is we often get asked this question: are we in a bubble? Is this a repeat of the '99 tech bubble? And it's as usual, kind of a gray area, a gray response in that it's yes and no. Yes, I think there are areas of the stock market and really, things outside of the stock market that have seen appreciations not support where they really kind of should be from a valuation standpoint. So, there are areas that are vulnerable, but overall, we don't think the market is susceptible to a significant downside. I think you really have to be careful on what you are investing in, the types of stocks that you're buying, because it's no longer, this winners take all type of environment where, these stocks go up forever and valuations don't matter. I think we're starting to see a return of that where it's become more of a stock picker's market. And a couple other things too is, we really expect that the dynamics in place going forward support the stock market in a general standpoint, because you've got, like I said, an economy that was very strong before the pandemic is now going to be coming back online. We've seen it. We're going to have a tremendous amount of pent-up demand unleashed on the economy in the second half of this year as we get to that kind of herd immunity standpoint. So from that standpoint, there's going to be a tremendous uptick in economic activity, as it's already started, as more and more people have become vaccinated. And the second key factor is there's a tremendous amount of liquidity in the system. Between the stimulus packages that were passed through 2020, the latest one for another 1.9 trillion. So not only do you have that kind of fiscal stimulus from Congress, but you've also got a very aggressive Fed that is already committed to running the economy hot, that wants to keep interest rates low for a very long time. They want to see their inflation targets exceeded for a certain period of time before they'll worry about raising rates and cooling off the economy. So you've got this really strong dynamic of pent-up economic activity and a pickup in demand, and a very accommodative government where a tremendous amount of money is being injected into the system. So from that standpoint, we're not concerned overall about some vulnerabilities in the market. But that said, there's certainly some areas that went too far too fast. We saw some stocks trading at multiples that were not heard of before, even in the '99 bubble. So some of these companies that were trading at 40, 50 times their sales revenue, they'd have to really operate at that level for many, many years before you really kind of grow into that valuation from a stock standpoint. So you have to be careful. There are definitely some bubbles out there that you have to be wary of. And I'll just take you back in time a little bit to give you an example of what I'm talking about with that scenario. And I'm gonna, let's see if this works here. Load up a slide here, and this is Amazon. So I've circled kind of 2 points on this chart. If you went back to '99 and when the tech stocks were all flying, Amazon, if you had bought into that kind of peak, if you had bought into that hysteria of, wow, look at all these internet-based stocks that are going to be true disruptors and be these tremendous business models going forward, that was true of Amazon. A lot of them failed, but that was absolutely true for Amazon. Yet, if you had bought at the wrong time, if you had bought at the peak of the mania, as you can see on this chart, it took you almost 10 years, 9 years and change, to get back to the levels of where you invested in it. So, and nothing changed with the business during this whole time frame. It was just as much a disruptor, basically right out of the gates. It started as kind of this online book business, but it certainly evolved very rapidly, started taking tremendous amount of market share. I think in this whole stretch of time where it was underwater from where it was in '99, it was growing revenue on an annual rate of north of 30%. So, just a tremendous business model, a winner from the get-go. But if you bought it at the wrong time, you were basically sitting on dead money for almost 10 years. So that's what I mean when it's like you got to be careful in this environment to recognize, what you're buying and kind of when you're buying it. You have to, valuations do matter. We had another thing that really kind of drove the market to some degree was we've had a whole new influx of investors as well, right? So, it's not just the institutions and the Wall Street people moving the stock market. You've had, a group of retail investors, the millennials and the people that didn't have the casinos open, they didn't have sporting events to gamble on, and so they kind of turned to the stock market. And we've seen all these kind of smaller investors through vehicles like a Robinhood that says, hey, come here and trade for free. And you've had this whole group of investors pile in, and they just look at what's the great story. Where's these long-term opportunities? Who's got the the story stock that I want to buy into, and I don't care what I pay for it. And so we've seen tremendous inflation in those types of stocks. So I think you got to be really careful about how you navigate in this market, because you might be right on the company, you might be right on the story, the theme. But, if you're getting in at the wrong time, it's going to take you a long time to realize that. So kind of be careful on how you navigate. And just one other, just to kind of illustrate, how we progressed last year when I talked about kind of the winners and the losers. This is a chart that looks at the difference between what we consider growth stocks and what are considered value stocks. So, the growth stocks, the obvious names that have very high revenue growth, a lot of cases don't really have the earnings yet. In fact, most cases, a lot of these companies don't make money at all. They're losing money, but their revenue growth is there. And then you have your traditional value stocks that, trade at reasonable PEs, price to earnings, maybe pay good dividends, are economically sensitive. So that's your bank stocks, your energy stocks, your industrials, things that again, are economically sensitive, and so through 2020, because of the pandemic, did not perform to the same level as those growth stocks. And so this kind of illustrates that there, where basically coming out of the March lows, growth stocks had a big divergence from value stocks. So value stocks came out of the initial sell-off when we had the stimulus packages passed in March and April. Stocks recovered kind of uniformly early on, but then it really separated between the winners and the losers, as I talked about. So, growth being up 70-something% out of the lows, where value flatlined, was up about 44%, but huge divergence there. Now, fortunately, we start to see that reverse, but I want to kind of stay on the topic of bubbles for a minute. And, in addition to, like I talked about, these new retail investors and money flowing into those high growth areas, the other factor that really drives it is something that I've already touched on, and that's just the amount of money that's being injected into the system. And that money has to find assets. People sit on money to some degree, and we've seen the savings rate go up and money and cash going up, but ultimately that money wants to be spent. I've seen some research that says of the stimulus money that's being sent out, everybody's getting their checks, more than 50% said it's going to go into either Bitcoin or stocks, right? So there's a tremendous amount of demand for assets with all this liquidity in the system. And just to illustrate that, I took a look at the amount of money just specifically that's been put into the system and kind of put it in perspective for you. So this is a chart, hopefully you can read it. I'd focus on the total cost at the bottom. So that first $3.5 billion I'm sorry, $3.5 trillion, was put in through the early parts of the pandemic and then towards year end. So that was the big $2 trillion package that was passed in April. And then December, we had an additional close to $1 trillion, about 900 billion, injected right at the end of the year in December. And now we've got another 1.9 trillion that we're kind of, fuel being thrown on the fire. So when you add all that up, that's almost $5.5 trillion being put into the system. To put that in perspective, in 2008, 2009 recession, we injected about $1.5 trillion between the economic relief program and the TARP, troubled asset relief program, which was about, I think, somewhere in the range of 5% roughly of GDP was stimulus that was injected in the 08-09 financial crisis. We're almost 4 times that amount this time around, and it's represents something like 25 to 27% of GDP. So that is just a tremendous amount of money floating around in the system, and it's led to not only bubbles in some of those high value stocks, but we're seeing in other areas that maybe didn't even exist before. One thing I wanted to touch on, because I didn't know anything about it until very recently, is something called NFTs, which stands for non-fungible tokens. Essentially, what it is the digital response to the art world. So now you have, because of blockchain technology, which supports Bitcoin, you have actual digital assets that are uniquely identifiable to that one person who owns that digital asset. So you have people. There's an artist known as Beeple, who basically took a bunch of digital images, put them together in one mosaic, and sold it for $69 million. There was the first time I'd heard about this, there was a video clip of Giannis Antetokounmpo, who's one of the best players in the NBA, and it was just a video clip, a highlight clip of him making his first basket in his rookie year, and that sold for I forget the number, $1 million, $2 million, whatever it was. And I sat there and I thought, geez, anybody anywhere can watch that video clip of him making a basket. You can go to YouTube or ESPN or Twitter, any of these things. Like, what am I missing here? And it's really a digital asset uniquely identifiable to you, but it just shows you the amount of excess in the system, the money where all this money needs to find a place to home, and whether it's in the art world, whether it's in electronic vehicle stocks, because that's the wave of the future. And one other area I wanted to touch on, because it's just talked about so much, and I don't know if most of you may not be aware of what these are, but there's been a proliferation of what are called SPACs. And a SPAC stands for a special purpose acquisition company. And essentially it's a way to take all these early stage new companies public, but not through the typical IPO channel, right? So you're a new company, you're raising cash, you want to go public, you've got a real business, real revenues, but to go public, there's a lot of disclosures that have to take place. There's a lot of filings, registration, disclosure, financial statements, and it's quite a process to bring your company public. So now we're really kind of become the hot button item are these things called SPACs, where it's basically managers raising capital from the public to then go and merge with one of these non-public companies, and it's a quick and dirty way to bring them public, right? But there's been such a proliferation of these SPACs that this year alone, just since January, there have been 289 of these funds that have launched to the tune of $93 billion. And what's kind of bothersome about it to me is that all these people are throwing money into these SPACs and they have no idea what they're buying. There's no business yet, right? So, I mean, you've got celebrities in the space. Jay-Z launches a SPAC and everybody, funds it, and he raises, whatever, $2 billion with the promise that I'm going to go find a good company to buy. So, you're throwing money at something that you don't even know what it is. So it highlights again some of the speculative nature and why you have to be careful about where you're investing and how you're investing. And so it's really, I think, become a much more of a stock picker's market. It can't just be this theme anymore of where the best ideas long term. It's got to be all right, are these companies valid? If so, are they at a reasonable price? And is this something that I want to own and can make money with over time? So, that's just an important area to talk about. And I had one more slide that I kind of wanted to use to illustrate that too, and that's the other side of it, not only the fiscal stimulus, but the aggressive Fed that I talked about. So another perspective here is this is the Fed's balance sheet, right? So not only are they keeping interest rates low, but they're also out buying assets in the open market. It's their asset purchasing program. So the Fed's balance sheet, all these bonds that they're buying back, right? It was around $2.5 trillion coming out of the 08-09 recession. The Fed's balance sheet's now it's over $7 trillion. So again, it just goes back and leads to that dynamic of how much money is fueling the system. I did want to also then talk about interest rates and what we've seen recently and what we anticipate going forward. I realize I'm already starting to bump into my time a little bit here, but we've seen in addition to the big moves that we saw in the stock market last year, we've seen an equally big move in interest rates. In fact, it was the biggest move in rates on record. It may not seem like it because we're still talking about such absolute low numbers, but the 10-year essentially went from 50-something basis points last year to 1.75%. It peaked at about a week ago, which is a tremendous move, and that's caused some ramifications within the stock market as well that I'll talk about. And so I just wanted to get a slide up here that shows you. I know it's a little bit of a busy slide, but this is basically outlining what's happening in the interest rate environment. So the first top part of the chart is the difference between short-term rates and long-term rates. It's the Fed can control short-term rates, but they don't have as much control over longer-term rates. So this is the spread between the 2-year Treasury and the 10-year Treasury, and it's the widest it's been since 2015. And really that's happening because we're at a situation now where the economy is going to start gaining steam. We have a reopening coming on, and so it's healthy that interest rates go from an absolute zero across the board to a more normalized interest rate environment, right? So longer term rates need to go up, and we've seen that happen in short order. As you can see how dramatic this increase is here on the spread between 2s and 10s. And here it's a little bit harder to read, but you have kind of an absolute value down here that shows you where this basically means the yield curve was flat. There was no difference between short-term rates and long-term rates. And then all of a sudden it's finally started to diverge, and longer-term interest rates have spiked up to this red dot while short-term rates stay low. Now that dynamic's going to stay in place, as I mentioned, because the Fed has indicated that they don't want to raise interest rates anytime soon. They felt they raised rates probably a little too early in 2015, and that they want to run the economy hot. So the byproduct of that is, unfortunately, that's had a impact on those growth stocks that we kind of talked about earlier. So here's a chart that I wanted to throw up that shows you what this move in interest rates has meant to this is the 10-year Treasury yield versus what's happened with the NASDAQ, the tech-heavy index. Again, a little bit busy, but as you can see, the real divergence where every time interest rates fell, growth stocks did well. When interest rates rose, tech stocks did very weak. And so, this is going back just this year, really. So now that we've seen interest rates spike higher very quickly, you can see that there's been a real strong relationship between growth stocks and what's going on in interest rates. And the reason for that is, when you have these companies where you're paying forward for all this expected growth, you're really buying into these things. They're long duration assets, right? You're paying for a tremendous amount of future growth. And so as interest rates are higher, your opportunity cost is higher, and that leads to lower current valuations for that future growth. So, not to kind of throw a lot at that one particular comment, but it shows you that there's vulnerability in some of those high growth stocks as interest rates move higher. And we do think they'll move higher. Our group and committee has projected about the 10-year to probably get up to about 2% by the end of the year. We had a really rapid increase from basically 90 basis points up to 1.75% in a real short order. Like I said, it was the quickest moving rates we've ever had. And that caused the market to kind of get spooked in the growth names. So I'm sorry. I guess I was on mute there for a second. I'm not sure how that happened. Thank you, Karen, for pointing that out. Basically, just to wrap up that point I was making, is just keep an eye on interest rates, because that will have an impact on growth stocks. I'm not sure exactly where I lost you, but basically, the way you value these growth companies is you're paying for future growth. And so as rates go higher, your opportunity cost is higher, and that causes a lower current valuation. So just keep an eye on that. We've seen it break apart a little bit in the last day of trading or so, where interest rates are starting to come back down, and the NASDAQ has continued to be weak, but it's still an important factor. And I think, as rates settle in here, probably in the short term, we do expect them to go higher in the second half of the year and end up around 2%. So just be aware of that as we move forward. And I know I'm already bumping up, but there's one important thing I want to circle back to.
Right. Let me just, this is Karen again.
Yeah.
We can extend, if everyone can stay on the line, maybe another 10 minutes or so, and then we'll answer the question. So please go ahead, Brendan.
Okay. Well, this is kind of a slide I wanted to circle back to, because, as I talked about, I showed earlier where you had this big divergence between growth stocks and value stocks, right? So last year, growth stocks did phenomenally well, and value stocks were kind of left by the side of the road. Now that interest rates have moved higher, we've seen that rotation go the other way. The script has been flipped. And so, if I fast forward from that prior chart and look up until current times, you can see specifically here, particularly starting at the end of January, where value stocks, which are really kind of your reopening plays, have done extremely well, and some of the money has come out of the stay-at-home growth stocks. That said, I think the main point I'm trying to make, and that I want everyone to take away, is that don't try to pick the winning and losing theme. Don't jump back and forth where, okay, one day it's the reopening stocks that are doing well, I got to put all my money there. No, rates are coming back down. Maybe the pandemic is going to last a little bit longer before everyone's vaccinated, so I'm going to go back to all my stay-at-home growth stocks. The answer lies in between, as it normally does. You got to be diversified. You have to know what you're buying. There's a place in your portfolio for both types of stocks. The one benefit that we've seen is, there are some really good, legitimate growth companies that have now reset and priced a little bit, right? They had these huge moves. In a lot of cases, they're off 45, 50% from their highs. Granted, they're probably still up 200-300% from where they started before the pandemic. But, we've seen a repricing. We've seen that rotation go the other way to now we're at a point where it's a stock picker's market again. It's not just pick the winner, pick the winning theme. It's pick the winning company. So be very careful about what you own. Make sure it makes sense long term, and make sure that it's at a reasonable price, which is good because, like I said, I think there's opportunities to have some of those growth stocks now that they're 45, 50% cheaper than they were. But you certainly want to be able to position for yourself for the reopening and have those value stocks that are going to benefit from the pent-up demand that's going to be unleashed in the second half. So, that's, again, the bank stocks have done very well. The industrial stocks, especially if we get the next rollout of some type of infrastructure spending plan. So be diversified, pay attention to valuations, avoid the highly speculative areas, and just stay focused on the long term. We don't see any significant downside of the overall markets. And stay diversified, own a little bit of both, because you'll benefit in the long run. So I'll wrap it up there and open it up to questions. I will say, Karen's been collecting, I believe, some questions all along, and we'll pose them here. I would just ask that, you kind of keep it to some general themes. I'm not really in a position where I want to be commenting on, a lot of individual stocks. Hey, what do you think of that stock or that stock? In most cases, as a fiduciary and as a wealth manager, I'm comfortable commenting on the stocks that we follow, we focus on, and are on our approved list. But I don't want to, I want to keep it a little bit general if we could. So, Karen, are there any questions that are queued up and ready to go?
Yeah, yes, there are. This is the first one that actually came in. Is real estate in a bubble?
No. I don't, but again, that's an area where you do have to be careful as well from an investing standpoint. of how you approach it, because I think there are some long-term dynamic shifts that have occurred where, interest rates are moving higher, but there is still a lot of demand for retail real estate investment because people are realizing that they don't need to be clustered heavily in cities and urban communities where they're able to spread out a little bit more. I don't think we're going to go back to 100% in office. I think there's going to be this hybrid model going forward. So you're going to have some element of work from home. But I think real estate will continue to do well from that investment standpoint. I think the areas that you'd be a little bit cautious on are in the commercial space, because I don't think capacity is going to come back to pre-pandemic levels. So I'm sure companies will be downsizing the amount of square footage they have. They'll probably keep an office space in the city, but it might be more of a shared space. So it's kind of, I don't think overall real estate's in a bubble. I think real estate will continue to do well. We're seeing employment numbers strengthen, which will bring back earning strength from a consumer standpoint, and I think housing will be supported. I don't think rates are going to go so high that it's going to disrupt the real estate market, but you just got to be careful. So it's not a clear answer, but it's you got to know exactly what you're buying.
Thank you, Brendan. Our next question is, what is your opinion on cryptocurrencies?
So that's another area that I think is a little bit, it's a combination of both. I think it's highly speculative. There's not a lot of fundamental support for what Bitcoin, I'll just pick on Bitcoin, is doing. That said, it's clearly going to be a part of the future going forward, and you're starting to see institutional money kind of come in because they don't want to be left on the sidelines. And so you've seen, again, more institutional investment, but you're really kind of speculating on price because there's actually a disconnect. There's not a real clear scenario where it's a true hedge against inflation like gold is. There's no real economic viable opportunity for it. Some companies are starting to accept it. I saw Tesla is going to start accepting Bitcoin, but it's very speculative. So it's not an area that we're ready to be involved in. And I think, while it certainly has a role long term, I think you have to be careful in the near term.
Thank you, Brendan. You were so detailed that we don't have other questions. So at this point, we'll just wait a minute or so if anyone wants to type in a question. And while that may be happening, I wanted to thank Brendan for taking us through this very important and timely topic. And we hope that all of you watching today have learned more about the market outlook and how that can relate to your investments. So I see no questions coming in. So the next thing to state is that a video recording of today's webinar will be available tomorrow on the homepage of our website. And that's at www.tsbawake24.com. It'll also be on the First Financial Trust website. And that is, and we're actually going to give you an email for them as well in case you had any follow-up. That email would be fft@firstfinancialtrust.com. Their phone number is 617-658-7600. We do have another question, and this is a very important one as we look into the future of 2021. So how will everything you said affect stocks as we move through the rest of 2021? I mean, what do you now see? You talked about the history and everything, so go forward.
Yeah, we're still bullish on stocks. So again, I was trying to stress that you have to be careful on how you navigate that, but overall, we think it's going to be very beneficial for stocks because of both the dynamics that I talked about. You've got a tremendous amount of pent-up demand that's going to be unleashed on the economy in the second half of the year. People are anxious to get out, travel, stay at a hotel, take a cruise, go to a restaurant, go to a ball game. And we've seen a lot of the stimulus money has actually been saved. Obviously the stimulus was needed and it supported those that really relied on it that were disrupted. But a lot of people, got money. It was kind of shotgun spread out across the whole spectrum, and everybody got money. And some of those that didn't need that money to necessarily live on have built it up and saved it and are ready to spend it. So I think that's going to benefit. I think you got to be in both areas. I think, growth stocks have repriced a little bit, so you can have an opportunity to add a name that you like long term. But I think the reopening stocks are very much a place you want to be as well. So that's in your value sectors. As interest rates go higher, that's good for banks. It's good for industrial stocks as we get some type of infrastructure spending. So it's really stressing that we're bullish on the stock environment because of all the stimulus, because of all the liquidity, and because of the return of economic activity. But just be diversified and be balanced in your approach and how you do it.
So it is 3:36. We'll go a little longer. We have another question. With rates so low, how can you find good fixed income products?
That's a challenge, isn't it? We do get so focused on where we need to be in the stock market. How do you find that yield? So there's a couple answers. I think in the near term, rates have moved up enough where you can put some of that shorter term money to work, extend out a little bit to get a little bit higher yield. We think there are some value going out a little bit on the curve to lock in some of these rates. And in other areas are interest rates that aren't fixed, right? So if you buy something that has a variable coupon, a floating rate coupon, that will benefit as interest rates move higher. The coupon will readjust, so that gives you some defensive nature to a rising interest rate environment because these will pay you more as rates go up. So that's another area to focus on. And we've actually added a little bit of inflation hedged fixed income securities. So one of the byproducts of injecting this amount of money into the system, $5.5 trillion in a Fed that's going to run the economy hot, is that there will be a pickup in inflation and higher prices, and so there are Treasury inflation protected securities that will benefit from a rise in overall prices in the economy. So I think those are a couple areas that you can benefit from: our inflation protected securities, variable coupon types of bonds, and going out a little bit on the yield curve to lock in a little bit higher interest rates. So kind of a barbell approach in that standpoint.
Thank you for the questions, and thank you, Brendan. Again, the recordings of this will be available on the front page of our website tomorrow. And we want to thank you all again for joining us today. Have a wonderful afternoon. Goodbye, everyone.